thus far, the economy has been strong enough that the economy has weathered the rate hikes. Now, let me be very clear, Kai. I wish there were no more Fed meetings ever. And I don't expect them to accomplish, at least on purpose, anything good. I think that you're in a managed economy, and I think an unmanaged economy would be better for all concerned, albeit more volatile.
Welcome back, everybody. Welcome to Soar Financially. My name is Kai Hoffman. I'm the @JRMining guy on Twitter and the CEO of the Soar Financial Group. And today we have a great guest joining us here on the program. And the theme of the program is going to be a bit of the summer market guide. There's lots to talk about. It's going to be fairly quiet, I think, on the news front over the summer, unless you will see drill results. But I mean, on the macro side, we only have one more Fed meeting coming up, and then it's going to be awfully quiet for at least 6 to 8 weeks. And we're going to talk about what the market is going to do, particularly the commodities. I've invited Rick Rule. He's a known quantity here on the channel. I think it's his third time on the channel, at least. Rick, we've done so many interviews, and it's been so much fun talking to you. Last time was right before, or end of January, I think we chatted here on this channel. So it's great to see you again. How you been?
A pleasure. Thank you, Kai. It's nice to be back with you.
Oh, absolutely. Yeah, no, it's great to have you on. And let's start with a holistic question, actually. Let's all-encompassing, probably could take all of 20 minutes to answer it as well. But what is your sort of, how do you rate the markets right now? How is the state of the global economy? And then we'll sort of, dive into some of the details.
I'm frankly surprised by the strength of the markets, and I'm surprised by the strength of the global economy. Given that the global economy has been a very long time without a recession, and given the fact that the global economy has had to deal with the shock of higher interest rates and the shock of at least a political war, I am surprised by the strength of the economy, basically every economy on the planet, and I'm surprised by the strength of the markets. Kai, as you've known me, I'm a fairly cautious individual. I'm a credit analyst, which means that I focus on getting paid back. And people like me are normally cautious. I joke that between Doug Casey and I, we have called absolutely accurately 17 of the last 3 declines. So certainly my outlook is cautious, but I have to say that the strength in the economy, even in the face of higher interest rates and a higher cost of capital, has been a real surprise to me, and frankly, a very pleasant surprise. I had expected much more trying times in 2023 than I've experienced.
Trying times, exactly. That's Jerome Powell said, and it's been quoted many, many times. But he was looking for something to break, and nothing's broken yet.
I would agree with that. I'm nervous that the economy will perform the way it did in the first decade of the 1970s, the first half of the decade of the 1970s, where the economy in the early part of the decade of the 1970s was able to stand both inflation and higher interest rates. But then the impact of higher interest rates in particular was felt in the middle part of the decade of the 1970s. Again, I'm not an economist, I'm a credit analyst, and I make this up, Kai, perhaps to explain circumstances that I don't understand fully. My nervousness is that the impact of higher interest rates will be a delayed punch. As an example, in the United States, despite the fact that 30-year fixed mortgage rates are up by more than 100%, you aren't seeing widespread decline in home prices. What you're seeing is a broad decline in volume, which is to say the buyers aren't willing or aren't able to pay as much as they were willing to pay 2 years ago, but the sellers' expectations are sticky. There's bigger gaps between the bid and the ask. I guess that resolves one of 2 ways, up or down. My nervousness is down. But again, I'm not an economist. I'm a lender. And so perhaps my worldview is shaped by what I do.
Well, you run a bank now as well, right? So that sort of shapes what what you're working on as well. Like that's why you're sort of a lender, as you said. Like what factors are you looking at in particular? Like job market, I think, is one of them. You mentioned housing. What are some of the prevalent indicators for you? Obviously, not just for the Fed, but for you as well.
The job market is incredibly buoyant, and I take some solace at that. It's interesting that the job market is buoyant only in two sectors, though. Low-wage service, where unskilled or semi-skilled workers generate such limited utility that they can't be paid living wages. That's booming. And then the highly skilled sector, the sort of 150 to 350,000 a year jobs that generate a lot of utility that require a lot of expertise. The incredible strength that we have seen in the highly skilled sector, the fact that, as an example, Silicon Valley can take 10,000 layoffs from some of the tech giants and absorb those workers in 6 weeks has really impressed me. I'm impressed too with the durability of the job markets in finance, both in equities and in credit. I would have expected Wall Street, in terms of hiring, to be much softer than they've been, but that hasn't been the case. I live in rural Northwest Washington, and the little community that I live in is experiencing such extraordinary labor shortages that, as an example, Safeway is paying people $20 an hour to start. The police department is paying people a $7,000 or $8,000 signing bonus, or a $30,000 bonus for a lateral transfer. There may be recessions in subsectors and in some regions, but I'm incredibly impressed with the strength of the economy, and not just the US economy, the European economy, challenged by much, much, much higher social and energy costs, and challenged too by what, if it isn't a war, is a very ugly police action in the Ukraine. I would have expected the Eurozone to be in much worse shape economically than it is. Even Germany seems able to afford hyper stupid energy policies, and appears to discount the challenges on its eastern and southeastern border in terms of sentiment. So I need to say that I, thus far, with regards to my own excessive cautiousness, have been wrong.
It's interesting what you're mentioning, like, and because the commodity market, the commodity complex, especially the precious metals, are holding up really, really well as well. Given that there's so many factors playing in, and one buzzword I just wrote down is Southern credit risk, and I'm looking at that, and there's so many buzzwords that come to mind based on your answer, like real yields. I think that's the biggest one as well, is
Right.
real yields. Talking about, because right now we're actually jumped over one. I just checked this morning. There's the 2-year versus the 10-year is over one, and I don't think I've seen it in the last 20, 25 years. I think 1982 was the last time when it was around that level. How does that impact gold in particular? Like, is that the reason gold is hanging in there?
I think that may be the reason that gold is hanging in there. I think the reason that gold hasn't soared, frankly, is that we were schooled by 40 years of benign economic climate beginning in 1982, and I would suggest ending in 2022. So I think that confidence is quite high. While I'm attracted to the performance of the broad economy, I am not attracted, but rather terrified when I look at collective, which is to say government balance sheets. We've talked about this on your show before. The strength of the US economy has not translated into covering the budget deficit, as an example, or dealing with the debt. And that circumstance is the same in Europe. I think that increasing nominal interest rates has made short-term deposits more attractive. And I think that has detracted from acceptance of precious metals. But I think a much more important reason is that because all of us were schooled in terms of our investment performance and expectation by 40 years of benign economic climate, which is to say we've been schooled not to become scared. I may be excessively scared, but when I look at gold and I think about the fact that, as you say, it's, quote, held up, I am really surprised that it hasn't gone further faster. When you talk, as an example, about real interest rates, understand that I would define a real interest rate as a rate paid as rent on savings that exceeded the depreciation of the currency that the savings were denominated in. And the forward-thinking measures of inflation, I think, are very misleading. As an example, when it suits them, they describe core inflation, which doesn't include food or fuel. As your listeners can tell by looking at me, I like to eat. And so that definition of inflation doesn't apply to me. But two, when they talk about CPI, Consumer Price Index rate of inflation, they're really trying to construct a cost of living index. And the fact that inflation doesn't include the cost of government, which is to say tax, which consumes more household income on average than food, energy, shelter, and travel combined, you truly have a fallacious index. And I guess that one of the things that has, I think, kept down the gold price is that consumers and investors and taxpayers have come to allow their interpretation of inflation, to be shaped by what is frankly a fraudulent method. When I look at the impact of increased taxation and the certain threat of more rapidly increasing tax on my budget, I understand that the stated measure of CPI has in no way measures my own cost of living. Now, Kai, if I didn't have to pay the tax, I probably wouldn't complain so much about the index. But I suspect that very much like in the 1970s, as people come to understand the impact of the deterioration of the purchasing power of their savings, that people will become less wedded to interest-yielding savings products and more interested in investments that traditionally have offered better shelter from inflation.
Well, Powell reiterated his 2% target for inflation. Since we're on that topic, I have to I was going to say I have to.
Fiction.
I have to follow up on that, right? So,
It's
how much
total
pain
fiction,
do we have to see to get to that?
But you have to measure. You have to measure how it's measured. Their 2% number works as long as people believe their inflation measurement matrix, which is itself fraudulent. When people focus on that number 2%, they need to focus on the measure of constructing that index and how that impacts their cost of living. Imagine that you're a Dane and that 58% of your household income is consumed by government, yet your government continues to run a deficit. Imagine now that your savings in euro-denominated bonds are yielding you 2% in euro, where the after-tax purchasing power of your savings is declining by 6.5% compounded. What you learn as a Dane is that your savings are costing you 4.5% of purchasing power a year, and you're ignoring the largest single factor in the depreciation of your purchasing power, which is to say increased taxation. I'm not saying this merely as a political statement, Kai, although I do like to propagandize. I'm saying this because people pay attention to easy to grasp headline statistics like a 2% inflation target. The problem with a 2% inflation target is that the measurement matrix that people are accepting is fraudulent.
Getting to that target, maybe one last topic on that, or maybe one last comment on this. I come to deflationary shocks because, as you said, the pendulum always swings too far out, right? Do you see a chance of that happening, in maybe in unison or in hand with the broader recession?
I see a huge chance of that happening, and I think that the policy response to a deflationary shock would be quantitative easing and government borrowing, which is to say, ironically, the policy response to deflation would be extremely inflationary. Again, we saw that in the mid-1970s. In the mid-1970s, we decided to raise interest rates further to combat inflation. That resolve lasted a sum total of 9 months, if my memory serves me well, before the political powers and, frankly, the voters decided to return to a policy of free beer and a free lunch, which couldn't last.
Absolutely. Let's try looking forward a little bit, given the context of what we just discussed. We have one more Fed meeting before the summer break, meaning they're taking August off, only coming back here September 19th and 20th. So, and I was a bit surprised, and I wasn't aware of that. There's only 4 more Fed meetings until the end of the year. We're getting October and November sort of bunched and lumped in together. Since this is a summer market guide, like what do you expect to happen? Fed Watch says 77% of a 25% basis point hike. The question is now, and I'll get to the second point of the question later, is what will it do to the markets?
Thus far, the economy has been strong enough that the economy has weathered the rate hikes. Now, let me be very clear, Kai. I wish there were no more Fed meetings, ever. And I don't expect them to accomplish, at least on purpose, anything good. I think that you're in a managed economy, and I think an unmanaged economy would be better for all concerned, albeit more volatile. I do think that the Fed has a sense of what real inflation looks like, a sense that's probably absent from the average household. And I think that the Fed is genuinely concerned about controlling those aspects of inflation that it can. If that's true, given the relative strength in the U.S. economy and the incredible strength in the bond market with negative real yields and the relative strength in the equities markets, I think that they have the opportunity for a 25 basis point increase. And I think that they will probably take it. I know certainly if I were them, I would take it. And I need to say, whether on purpose or not, that the Fed has done a relatively elegant job in the last 2 years, engineering higher nominal interest rates, albeit not real interest rates yet, while relying on the strength of the private economy to finance the sins of the collectivist economy. I'm incredibly impressed. And I'm sure that no real credit goes either to the Fed or Congress, but I'm incredibly impressed with the way that the U.S. economy in particular has dealt with a higher cost of borrowing in an over-leveraged economy. It could be, stranger things have happened, that they could engineer a soft landing. It could be that they could bring the expectation of inflation, at least inflation by their measure, down to 3%, while maintaining a 5% yield on U.S. one-year treasuries, which is to say that they may actually be successful in generating a positive real yield if the economy can hold in. And I think that would be a major accomplishment. I'm not sure whether, well, I am sure. I don't think they get the credit. I think average American business people and average American workers who generate utility in a real economy get the credit. I think the Fed and the government continue to get what they deserve, which is to say the blame. But I am, and this is going to sound like an American-centric comment. I don't mean it to. I think that the creativity and tenacity of the private sector means that individually we create so much value that we can usually finance our collective stupidity. And this is another lesson of that. And it's very impressive.
Absolutely. The entrepreneurism in the US is, where is it? First, absolutely first in the world. If you look at patents registered, for example, if you want to take that as a benchmark, second to none, I think. So,
really around the world, I'm amazed now at the ingenuity that's beginning to be displayed in Africa. A place that people had written off. This sort of technology revolution, the startup revolution in Africa. This guy Dangote, who's revolutionized the sugar industry in Nigeria, then the cement industry, now the oil refining industry. It's almost like one guy can create light in a country, Nigeria, where so much wealth has been wasted and stolen by the government that one of the richest nations in the world is bankrupt. This juxtaposition between what he has been able to accomplish, albeit in league with the kleptocrats who run the country, it's just amazing, the juxtaposition between private accomplishment and public, how would you call it, destruction.
Yeah, well, you have that in the US as well. You have Elon Musk, for example, just showing them how EVs are being built, right? Just as an example. I want to get to the second part of my questions, just so we can segue more into the gold discussion here as well. Because based on what the Fed is doing, it seems like whenever Powell says, well, we'll have 2 more rate hikes this year, gold takes a breather, right? Mm-hmm. And we've had that discussion in January as well. I think it feels a bit like, hey, we're trying to beat the Fed. We had that Fed rally. We had great mood at the conference in Vancouver. And then the Fed says, well, we're not done hiking yet. Everybody expected them to maybe stop at 4%. Now we're at 5.25%. And now he says, well, there might be 2 more rate hikes this year, and we only got 4 more meetings. So he's taking the air out of our, let's say, call it the gold balloon, or the fuel out of the gold rocket, whatever acronym you want to use there. How do you see that playing out for the commodities now, especially gold and silver?
I guess I have a different orientation and a different time frame. I don't own gold for a move from 1950 to 2075. I own gold to preserve my wealth. Ironically, Kai, and your listeners are going to hate this because they're young and aggressive and all these kind of things, and they're trying to make their car payments and stuff like that. I own a lot of gold, and I kind of hope the price doesn't go up. For me, precious metals are catastrophe insurance, and I just as soon not have a catastrophe. I hope when I shed my mortal coil, however old I am, that I look back and say, owning all that gold was a waste, but it allows me to sleep nights and stay calm. I guess as a consequence of that orientation, I'm much less time sensitive. I own gold and silver, and I own most equities with a 5-year term or a 10-year term. It's odd now that I'm 70 years of age and I have less time on earth that I've become much more patient. When I was 21 or 22, I sort of thought that what happened over the next 2 or 3 months was relevant. But it's so impossible to forecast, and the moves that you can enjoy in 2 or 3 months are so small that they really aren't relevant. 5-year timeframes, 6-year timeframes, 10-year timeframes are very relevant. And we've discussed this before on your show, Kai, when I look back at the speculative moves that have really made a difference to me, the 10 baggers, the 15 baggers, the 20 baggers, characteristically, they took 5 or 6 years to work out. I may have wanted them to take place in a quarter, but what I wanted is irrelevant. Why want what you can't have? They did take 5 or 6 years. And by the way, almost every 10 bagger I ever enjoyed delivered me a 50% share price decline sometime during my holding period. So in addition to being patient, you have to be persistent. And people who pay too much attention to the Fed and not enough attention to the underlying investment attributes, and people whose time horizons are inconsistent with the time demands to achieve the investment outcomes that they're trying to cause to occur, are doomed to failure. If you have a 3-month orientation in what is a 6 or 7 year cycle, you will snatch defeat from the jaws of victory just because your investment orientation is out of sync with what is required to experience the outcome that you're hoping for. It's very perverse.
Absolutely. Let's sort of switch to the miners there as well, because the miners the last 3 months have just been sort of on the bottom. Like brings me
Yep.
John Kaiser's bottom fish. They're just
Yep.
at the bottom of the sea. The charts all look the same. They're all flat, little bumps, and like brings me to a question I wrote down for you. Is like, is 2023 a lost year for the miners already, and it's only the end of June?
2023 has been a very good year for me. I think the aggregate of my managed accounts are up sort of 22 or 23%. So I would suggest that the junior miners are suffering malaise of their own making. We've described before that if the universe is 2,500, I don't know what the number is, probably 2,000 are valueless. And if you look at the fact that probably 80% of the listings are valueless, maybe 75, the fact that we still have a junior market at all is heartening. I would point out the performance of those companies who have delivered. The so-called boring sector, the construction and development phase. What you're doing is you're watching some of the companies that are doing a good job there really, really, really perform. Perversely, those who hadn't performed before and gotten ahead of themselves. And you're finding, too, those companies who are delivering good exploration results, albeit they're few and far between, being rewarded in the market. What you aren't seeing is a return of the dumb money. You aren't seeing the type of speculator that you would have seen in the market in the sort of 2010, 2011 phase, that sort of thing. You haven't seen the incredible rush of dumb, narrative-oriented market money into the market. From my point of view, that's a good thing. One further bit of editorializing. Despite the fact that I guess I don't need to, I'd like to become wealthier. And you become wealthier by buying assets when they're out of favor and selling them when they return to favor. So the fact that the industry is in self-described torpor, for me, isn't a bad thing. It's a good thing. I'm a buyer. Now, I can't say that the torpor has been such that I have been able to buy with abandon, but I certainly am impressed that some of the stocks that I would like to buy, the Centauruses of the world, the Silvercrests of the world, some of the explorers have enjoyed, if that's the right phrase, no share price appreciation, in fact, share price depreciation, when the underlying value of the company continues to increase quarter by quarter. From my point of view as a buyer, that's a wonderful thing.
Are you a dip buyer, Rick? Are you buying the dip? We got to use that term here.
That's not the way I think.
Yeah.
I mean, I think a dip in the junior mining sector would be for it to go to its intrinsic value, which is zero. I would describe these as perturbations, not dips. What I try to do is I look at a whole company and I try to anticipate as best I can what it's worth and what it's likely to be worth in 18 months and then 5 years, based on a set of circumstances, probabilities that are, to my mind, more likely than not to occur. Let's say that I think that XYZ company is likely worth $1. And let's say that by answering a series of unanswered questions, I think it's likely to be worth $2 18 months from now. And let's say that I think it's possible that 5 years from now, it could be worth $10. If that stock is selling for $2 now, and I think it's likely to be worth $2 18 months from now, obviously I'm not going to buy it. Why would I pay for 18 months of stagnant value creation? If by contrast, that stock is at 80 cents or 75 cents, I'll likely buy some. And if I've done all the work to establish what I think it's worth and what it's likely to be worth, and it falls from 75 cents to 50 cents, I'll likely fill my boots.
Talking about filling your boots, we always talk financing activity. And last couple of times you said, well, you want the sector to stay cheap because you want to write checks and you want to offer money to companies on your terms and not the company's terms. Question now, is the market still cheap enough? Have you written checks and have companies accepted your financings? Because last we spoke, they didn't.
I think the high quality junior market is very much like the US housing market, which is to say there's a gap between the bid and the ask. Existing investors and managers are trying to get 3-year-ago valuation levels. And investors like myself are trying to get 10-year-ago terms. If somebody wants to come to me with a market-related financing, let's say the stock's selling for $1 and they want to do the financing at $1, and they want to give me restricted stock, they better give me a warrant. If they don't give me a warrant, I will, quote, as you say, buy the dips. For sure, in the next 4 months, 5 months, 6 months, something will happen which will give me a buying opportunity. And if I don't get a warrant, why wouldn't I buy unrestricted stock in the free market for a savings? Now, I will say I've been much more active in the lending side of the business because equity has become more expensive. More companies have decided that their shares are genuinely undervalued, and they've chosen the inconvenient method of having to pay me interest. And of course, they've taken the risk of being unable to pay me back by going into the debt market. If a company really truly believes that its equity is 50% undervalued, then borrowing money at a 12 or 13% interest rate is actually cheap. What you'll find is that this apparent undervaluation only exists in news releases, not really always in the mind of the insiders. But increasingly, we have a circumstance in the market now where the insiders and their backers are coming to believe that their stocks are undervalued by 40 or 50 or 60%. And in that case, doing debt transactions has benefit to them.
I'm just pulling up the chart financing activity as well, because I want to briefly talk about that. Because we've seen a lot of bigger financings, as you said, the bigger boys, the developers, they've been financing. And I've been saying go big or go home when it comes to financings, right? Because who cares?
I would say go legitimate or go home.
Yeah, that's even better.
The market is bifurcated for the better. You have some very high quality teams, some very high quality investors, some very high quality juniors. And they have been able to raise a lot of money. Look at what the Lundins have been able to do, even burdened by the death, rest in peace, of Lucas Lundin, who was the market's face. Because the Lundins have performed for years and because they have high quality assets, when they go out to raise $80 million, they come back with 110. If by contrast, you look at some junior explorer, let's call it for laughs, Amalgamated Moose Pasture, $4 million market cap that spent $1 million last year, $650,000 of it on G&A, and $350,000 in the ground. And by the way, they didn't find much. That company is justifiably having a hard time raising money. If you assume that the market cap is $4 million, if they could raise any money under any circumstances, it would be accretive because the net present value of Amalgamated Moose Pasture is zero. And if you can raise money at a $4 million market cap, you should do it because you're stealing the money. The chart that you exhibit doesn't go so much, I think, to the state of investors' willingness to finance. It goes to the fact that the Canadian junior resource sector is inhabited by too many zombies and cockroaches who are unfinanceable.
Oh, I fully agree. And they don't go away for some reason. We didn't see them exit the market in 14, 15. They keep coming back.
Amazing, like cockroaches. They're tough to kill.
Unbelievable. Rick, we're running out of time here a little bit. I got two rapid fire questions for you, which I'm just going to fire out here. Have you written any checks lately?
I have. I have. Now, I need to say, in the last 18 months, 75% of the checks that I've written have been oil and gas checks. That has been a much better sector in terms of return on capital employed, but much more importantly, in terms of management and investment efficiency. And I suspect that circumstance will continue. On the junior resource side, the mineral side, I'd say that 3/4 of the checks that I've written have been structured debt related, and only 1/4 of the new allocations have been equity. That isn't to say that there haven't been a lot of opportunities that I would have liked to have participated in, but I didn't like the structure too much.
Okay, fair enough. Let's get on to the next question. And how do you suggest investors behave, given everybody's portfolio is different, over the summer? Buy, hold, or sell, if you have to choose one.
Buy. But be very selective what you buy. There are a couple times a year where historically there's been some seasonality in investments. The summer is a slow period, which means more likely than not that stocks are cheap. And then the stocks rebound up in the fall. Now, for some reason, people need the psychological stimulation of a rising market. In other words, people would rather pay more. If you were a trader, I'm not. If you were a trader, you would buy in the doldrums, and then you would sell into the fall. Stocks often fall precipitously in November and December, tax loss selling, before they exhibit the January dead cat bounce and the so-called PDAC market, where they go up in the fall. So again, if you were a trader, one would assume that you would buy stocks in November and December when you're scared shitless and nobody wants them. You would buy stocks in June, July, and August when you're bored. By the way, boredom, I think, is an antidote to terror. And you would sell those stocks in the buoyant rising markets that everybody liked. Mercifully for me, most speculators act in ways that are contrary to their own interest.
Always do, don't they? Like, it reminds me of the Tesla meme, where people buy Tesla at 150. There's one person standing there, buy Tesla at 250, the full lineup, right?
Right.
So that just reminds me of that. Since we're doing rapid fire questions, I've got one out of left field for you. Who should I interview next?
Who should you interview next? That's a wonderful question. If your interest is global macro, which I think some of your listeners are interested in, I would interview Grant Williams. Grant consistently outpolls me at my own conference as best speaker. If I wasn't so focused on delivering value, I'd be angry about that. I would also interview Robert Friedland, who, although he's well regarded, is still, I think, an undervalued resource. If you look at Robert's track record at delivering successful exploration and development over the 4 decades that I've known him, he's without peer. He's also a superb interviewer, or pardon me, interviewee.
Very difficult to get a hold of, though. He does do a lot of podcasts, so I might have to take my chance. I have to try again. So,
yeah, I would certainly look at those two. Another one who's, do you know Brian Dalton?
No, I don't.
Brian Dalton is the founder and CEO of Altius. He has taken that stock in the 20-something years I've owned it from a nickel to now $14, having been as high as 45. He is one of the best allocators of capital in the junior resource space. His company generates a lot of free cash and has a fortress balance sheet. And they haven't done it by financing to widows and orphans. They've done it with the superb allocation of capital and by monetizing their successful efforts. So I certainly, if I were you, would, if you had the opportunity, interview Brian Dalton. Very common sense guy. so he isn't asked to interview very often.
I'll ask him. No, I think we both know a connection that can connect us. So
I can do it if nobody else can.
I know, I appreciate that. But let's segue to your conference, because Grant Williams is a speaker, and I'm totally
Yep.
bummed that I can't attend in person. My daughter's birthday, third birthday.
Yep.
I can't travel, right? But let's talk about your conference, because the Rules Symposium is this year is in Boca Raton at a beautiful resort. I was on the website earlier, which adds massively to the FOMO. But tell us about the program, because I think it's going to be hugely insightful.
Well, I think it's important to note that our conference has existed under one guise or another for about 30 years, which means it's stood the test of time to begin with. Why has it stood the test of time? Well, first of all, we've done a good job and continue to do a good job by gathering the true gurus, the big picture thinkers, the Jim Rickards, the Doug Caseys, the Bill Bonners, the Grant Williams, the Nomi Prinzes. These people have a paradigm around the world that's useful, but not the type of paradigm that you would see on NBC or BBC or CBS. I think that's very useful. If you agree with that paradigm, because that paradigm is essential for precious metals and natural resources, if you agree with it, we have a variety of portfolio managers and analysts who have been in the game for 30 years. They've seen good markets and bad, and they can tell you how to act with your own money if you agree with that big picture paradigm. But more importantly, I think, every year we have a group that we call the Living Legends, who are entrepreneurs who have built multi-billion-dollar companies from scratch. This is where the rubber meets the road. And they tell you how the lessons that they've learned have made them better investors, how it's made them contrarian, how it's made them focus on real exploration science and real balance sheet finance. You aren't in this circumstance learning about investment from a journalist. You're learning about investment from somebody who has created multiples of billions of dollars from a standing start. At our conference, too, our attendees have told us that our exhibitors aren't merely advertisers, but they're content, too. And so the consequence of that is that the exhibitors are chosen on a qualitative basis, which is to say, very specifically, if the exhibitors aren't owned in an account managed by me or in my account or an account managed by Sprott, they can't exhibit. It doesn't mean, sadly, Kai, that every stock that I buy goes up.
No.
What it does mean is that every exhibitor has been vetted and has passed the test well enough that I've invested my own time and treasure in owning them. Finally, understand that my conference is available physically, but also virtually. We're going to live stream it. So you can't use your daughter's birthday as an excuse. And both constituencies, the people who pitch up live or the people who watch it from the comfort of their own home virtually, will be able to access the conference recordings for 6 months after the conference. I myself have found, despite the fact that I put on the conference, I need to watch it an average of 4 times to play back and understand information that is useful but dense. So the ability to do that, the ability through technology to have this event not take place over 4 days, but rather take place over 6 months, is absolutely imperative, I think. And finally, Kai, my conference comes with a 100% ironclad, no excuses, money back guarantee. If you attend my conference virtually or physically, and you don't feel for any reason that you didn't get your monies back, email me and I'll send you your money back. We would prefer it if you told us why, so that we can make the conference better next year. But that requirement is not a requirement. We have an ironclad money back guarantee. I take the financial risk of your attendance. And so for those reasons, I urge everybody who is serious about natural resources and precious metals investments to attend. Now, listen, if your real interest is crypto, or your real interest is technology, if your real interest is pot stocks or psilocybin, don't come. If you are interested in natural resources, precious metals, and energy, do come. If you don't feel like I gave you your money back, your money's worth, I'll give you your money back.
Yeah. So attend, complain about the food, and you get a free ride. Fantastic.
Whatever.
Fantastic. No, right. We'll put a link right up here. There's going to be an info card right around there somewhere. I'm going to put that up on YouTube as well with a direct link so people can sign up. And as always, Rick, I tremendously appreciated your time. Thank you so much. We've been chatting now for 44 minutes, so it's been always a pleasure. It's good to see you.
Kai,
Good luck with the
Kai,
conference.
the pleasure is mine. And once again, any of your listeners who want to continue a conversation with me can go to ruleinvestmentmedia.com, enter your natural resource stocks. I'll personally rank them 1 to 10 and comment where I think on individual issues where I think my comments might have value. Once again, ruleinvestmentmedia.com. Please no tech stocks, please no pot stocks, please no crypto, just natural resource stocks. Leave an old man to do what he does best.
Fantastic. Rick, that's an awesome service. Thank you so much. And we'll be back with more. Thank you so much for joining us. Don't forget to hit that subscribe button if you enjoyed this conversation. Because if we grow, we can continue bringing on great investors, great minds of our sector here onto this program. It's much appreciated. Thank you so much for tuning in. We'll be back with lots more here on this channel. Thank you so much.